Dividend stocks have one major drawback. Most often, they only pay once every quarter, sometimes only on a semi-annual basis. And while that may not seem like a problem, your mortgage, your cable bill, your utility bills, and your car payments are likely due every month. But getting a monthly dividend could be the answer. So, let's take a look. Most investors have never heard of a business development company or a BDC, but they can be some of the biggest yielding stocks around. BDCs are set up as pass-through entities, much like real estate investment trusts, and must also pay out at least 90% of their earnings as dividends. How they earn that income is by loaning cash to mid-sized companies that are too big for the local bank and not big enough to launch a bond offering at a competitive rate. When it comes to BDCs, Main Street Capital, or Main, could be one of the best. Main has provided capital to more than 200 private companies, and thanks to its underwriting and deal standards, it's been very successful at turning a profit. As of the first quarter of 2019, Main has already seen its investment income rise by 10% year over year. As a result, Maine has become a great dividend stock since its IPO in 2007. And since its IPO, Maine has grown its payout by 127%. Recently, Maine has been paying a monthly dividend with a yield of 5.89%. Additionally, and on occasion, Maine rewards shareholders with supplemental dividends. Considering the extra payouts, investors are achieving closer to a yield of 7.2%. So, let's take a look at our charts. And we're looking at the 20-year monthly chart on Main Street Capital Corp, and the symbol is Main, M-A-I-N. And simply looking at the price chart here, we can see that we had the top there in 2002, basing period here 2003 to 2005, and then the step up into the top there 2008 with the decline down to the bottom in 2009, that basing period, and then on up here, basing period in 2011 with another move on up here and a longer basing period, and we're going to call it, say, 2014 through 2016, and then the step up here. Now, this basing period in 2018, 2019 may be finished. It looks like that was a time frame there, and we've popped up. I'm not sure if we're at an all-time high, but it certainly looks promising. Now let's go take a look at the MAC, and I think you're going to see similar pattern here. Again, the top in 2002, basing period in 2003 to 2005, with the move on up here, and of course the great financial crisis, the bottom here in 2009, and this is going to be a basing period through here with that move up there, and then a big decline in the MAC all the way down to the bottom in 2015, 2016, but then of course the recovery here. And now again, I think we've had this basing period here as shown by the MAC. And I think if you go back up to the price chart, you're going to see the similarities there in the moves. So my current thesis is that the current basing period from 2018 to 2019 is done and we're on up. And that's also what's shown in the MAC with the fast line moving through the slow line here just recently, and we're above zero, so we have strength. Looking in the histogram, much the same. Price rate of change, I like this. And you've heard me talk about the period of 2015 to 2016 as being similar to the formations that we see currently, and it shows up in many, many, many stocks, and it shows up here in Maine. So that's the basing. That's the fast line moving above the slow line, above zero, gaining strength. I think it's going to be on its way. Same thing there with the RSI as well as in the stochastics. Very similar base and run, very similar base, and I think we're going to run. Volume, uptick in volume from the lows back there, say 2010, we came up and to this level here, and we've probably stayed somewhat sideways in the volume for the last several years, but that's not bad, and it's not great, but it's acceptable. And then the Williams, much the same basing pattern, and we're moving on up, back up to the price chart. I think this pattern is going to repeat once again. So, for your consideration, Main Street Capital Corp, as usual, conduct your fundamental analysis. Let's go to the next stock. The telecom industry is dominated by AT&T and T and Verizon. The problem is that neither is a monthly dividend stock, but Canada's Shaw Communications, symbol SJR, is. Shaw is one of Canada's largest telecom companies and offers cable and internet and wireless phone services. It has been doing this for decades. Cord cutting of telecom companies has become a recent problem. However, Shaw has been able to successfully convert customers to faster internet service to overcome lower cable subscriptions, helping boost revenues. Additionally, Shaw has been one of the first movers in Canada for new 5G networks. As Shaw moves forward in these businesses, investors can relax and collect a sizable monthly yield. Currently, Shaw pays a dividend yield of about 4.5%. You need to understand that this dividend will fluctuate based on the exchange rate of the US Canadian dollar. However, given Shaw's stability and potential growth, that's a small price to pay for a great dividend stock. So, let's take a look at our charts. And we're looking at the 20-year monthly chart on Shaw Communications, and the symbol is SJR. For disclosure purposes, I do not hold any shares of Shaw Communications at this time. Looking at the price chart, the bottom there in 2002, the next bottom here in 2009. But since 2009, even though there's an upward bias to that trend line, there really hasn't been much progress in that price. Going down here to the MACD, you can kind of see the problem that the MAC never was able to go much above, say, that line there, which is about a 1 since 2009. And then it dropped down here in 2016. The current level, if that it is basing, and I think it is still under 0. So I don't think that this is going to be heading up in price all that fast. Now, the offset factor is you're collecting a hefty dividend. MACD shows much the same. Price rate of change also much the same. RSI is 52.19. That's moderate, but not real strong. So it's not really all that favorable in my mind. Stochastics looks fine, heading on up, just piercing above that 50 line here recently. Volume does look better with an increase in volume, a slight drop in the recent year and a half or so, but that's not much of a problem. And then the Williams shows, much like the other oscillators, it's improving as well. But going back to the price chart here, even if you are going to collect a hefty dividend, I'd like to see appreciation in the underlying stock, and I don't necessarily see that here with Shaw Communications. So choose this if you want. It's your decision, but as usual, conduct your fundamental analysis. So for today, that's Two Dog Charts. Thank you.